I think the use case, which Chris and I have been discussing previously, I think opens up a lot more for Shopify is those consumers in emerging markets. So folks who, if you think about a currency like Argentinian peso, right, or Nigerian naira, we would even have, members of staff on our site who'd be asking us for salary payments in USDT, or it's not difficult for me to imagine a world where those people would be very willing to, not just do things with their savings there, but also avail of an opportunity to pay for something on a site that you have to bear in mind as well, Simon. In many of these cases, these people can't buy from these platforms because the platforms aren't localized, the cards they have are not enabled, the bank won't give them a loan, etc. And they're excluded really from that global financial system. So I think it's, as an inclusive move globally, it's much more interesting.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of real-world assets. My name is Simon Taylor. I'm your host for today and author at FinTech Brain Food and head of strategy over at Sardine. There is no Kai Sheffield today. He's on a plane, taking my place of missing a few shows. But I promise you, the Sai and Kai double act will be back soon. But my goodness, joining me for today's show are some incredible guests. Making a return for the third, possibly even fourth time, is Chris Harmse, the Chief Business Officer and co-founder of BVNK. How are you doing, Chris?
Great. Very good to be here with you, Simon. Back for a fourth, indeed.
Oh, man, you're just too good to quit. It's those insights, you just keep dropping them. And of course, making a debut is John O'Brien, who is Chief Revenue Officer of a fintech company called dLocal. John, how are you doing?
Good. Very impressed with your pronunciation of our moniker as a company there, Simon, emphasizing the dLocal. So no, great to be with you, and nice to catch up with Chris again, and happy to dive into the topics and have a good discussion.
Yeah, Chris knows I'm great at pronunciation, and if you haven't heard that episode, then you should check it out. Good callback, guys. All right, just one last bit before we get into the fun of the content. I have to remind everybody that views and opinions of contributors may well be their own and might not reflect the companies they represent. And please don't take anything we say as tax, financial, legal, investment, sports, fashion, or any other form of advice. Do your own research, folks. All right, the first story this week came from everywhere, and this is Shopify unveiling the ability to accept stablecoins for payments. So the e-commerce giant announced that merchants can now accept stablecoins through a collaboration with Coinbase and Stripe. An interesting aspect of this alliance is it's built on joint work involving a smart contract, or the e-commerce payment protocol, that mimics the two-step card process of authorize and then capture with an escrow contract. So this announcement is potentially positioning Shopify as enabling cross-border payments with no foreign transactions or exchange fees. But Chris, I look at this and I wonder, who's the ideal customer for this, and is this PR, or do you expect to see real volume for something like this based on what you see in the market? You see lots of cross-border activity.
Yeah, I think it's really good to see that the merchant acceptance checkout use case gaining some momentum. At BVNK, we've been powering stablecoin acceptance for the last 3 years, but they've really been more focused on other verticals outside of e-commerce. So think, retail trading platforms, think PSPs, think even some luxury, but never really gone mainstream into e-commerce. And I think this announcement with Shopify actually changes that. Shopify is the ultimate e-com platform, doing about $1 trillion in TPV across across e-com. And so I'm quite excited to see the adoption within e-commerce, because I feel like it was the last use case waiting to drop or to really get to scale, was getting stablecoin acceptance alongside cards and digital pay, other sorts of local payment methods. So I think it's a super exciting use case. and a super exciting announcement. And then just more specifically around that kind of commerce payment protocol. I mean, this one's quite e-com focused, like it's the commerce payments protocol, protocol for base. But I think, when we were building over the last couple of years, I think it's always been quite a challenge when we started scaling this stablecoin payments product, because we would, we're a blockchain agnostic platform across multiple different stablecoins. Consumers end up making mistakes. So they'll pay with the correct token on the wrong blockchain, or they'll pay with the wrong token on the correct network, or they pay the incorrect amount at checkout. So having some sort of standardized protocol for kind of crypto checkout flows, I think is a great idea, and something, we were thinking through, how do you do this in some sort of consortium? But yeah, it seems like, we're heading in the right direction with this sort of kind of standardized payments protocol. So I think it's just overall quite exciting news for that specific merchant acceptance use case.
Yeah, I'll come back to the protocol, but John, I wanted to pick your brain on kind of the idea of sort of the latent demand for e-commerce in markets that are, historically labeled the global south, for sellers from that part of the world, maybe selling into the global north, or being able to make payments. Like, who would you see as the ideal customer of this product from Shopify?
Yeah, to be honest, it's hard to know, Simon, when you look at it, because if you think about where the majority of people who are buying from Shopify are today, or where that TPV number that Chris mentioned is arising from, it's going to be in the US, right? Where it's very hard for me to see that people who've got pretty embedded spending and user habits, right? I mean, I've purchased using Shopify before. My card's locked in with Stripe. It's a very smooth experience, So I think there would have to be something very well thought through outside of just, I think, the dynamics around the protocol as it relates to incentives for people to migrate over there. I mean, Shopify, Amazon, other platforms have thought long and hard about things like open banking, let's say in the UK here, or FedNow in the US. And still, I'd say the adoption of those protocols, even though they're very cost sensitive, has been relatively anemic, So I think the use case, which Chris and I have been discussing previously, I think opens up a lot more for Shopify, is those consumers in emerging markets. So folks who, if you think about a currency like Argentinian peso, right, or Nigerian naira, we would even have, members of staff on our site who'd be asking us for salary payments in USDT, or USDT primarily in emerging markets. Don't tell the Circle guys who said that, but that's primarily how things are operating there. And it's not difficult for me to imagine a world where those people would be very willing to, not just do things with their savings there, but also avail of an opportunity to pay for something on a site that you have to bear in mind as well, Simon. In many of these cases, these people can't buy from these platforms because the platforms aren't localized. The cards they have are not enabled. The bank won't give them a loan, etc. And they're excluded really from that global financial system. So I think it's, as an inclusive move globally, it's much more interesting. In the short term, in terms of the economic impact it will have for, the GMV of Shopify and a lot more incremental sales, I think remains to be seen how they market it more. When I read it yesterday, I think of course, we have our bias about emerging markets because what the company's focused on, but it was very like a US centric and heavy kind of push with it, as was some of the other news kind of this week too, which, that's also how our global news goes. It's pretty dominated by the American cycles. But yeah, I'd like to see a bit more color on it as the product expands. But I think, as Chris said, it's great to see the adoption and the people are pushing it. And I can certainly see the use case because it's something we live day to day in the markets we operate.
Yeah, people forget that 75% plus of Shopify's revenue comes from payments. You think of them as the e-commerce site, but it's the payment facilitation where they make their money. And I just wondered if this is expanding their TAM on the merchant side, on the consumer side, so consumers can buy from the global north, and the merchants in the global south can sell to the global north. And Chris, I think you were speaking to some of the challenges with that. Chris, I'm going to come back to that protocol thing because it introduces two concepts: the idea of escrow and operator. So funds from somebody like the consumer who's making a payment are collected into the escrow, I guess, wallet before being transferred on to the merchant. And then the operator can essentially facilitate that transfer of funds from escrow to the merchant or back to the payer based on the outcome of, were the goods delivered or were they not. As I look at this commerce protocol, it starts to sound like it's got consumer protections baked in. It starts to sound like what we would have called a chargeback and all of those card sort of things. Do you think that's going to be essential for consumers to use this stuff? And do you think we're going to see more people trying things like this?
Yeah, I mean, I think exactly that. You're starting to see the power of programmable payments. So this is where the escrow contract, you bring that smart contract in to allow for programmability into a payment that was kind of set at the network level, let's say in like a Visa net or that sort of thing. So I think it's quite exciting to start baking those rules into the actual payment, or or into this protocol that kind of executes itself, through a smart contract. So I'm quite excited to see how that develops. I think it is early days to see where that protocol gets to. It's obviously on one blockchain being based, but I think it's just starting to show that this infrastructure can be rules-based, and it can be rules-based based on smart contracts that execute themselves based on predefined conditions. So, I think, we've spoken before about, we're solving payment problems, the speed, the cost reductions of all stablecoins, but very rarely do we start talking about the programmability of stablecoins. I think this is a good example of that.
I wrote a piece called "Stablecoins Aren't Cheaper, They're Better," and often, frankly, they are cheaper. But that's not the point. There's a whole bunch of other benefits we start to get. And I wonder if our next story is more about the programmability or the cost, because this story came from the Wall Street Journal. And apparently, Walmart and Amazon, you may have heard of them, are exploring issuing their own stablecoins. The decisions would depend on the Genius Act, the bill which just passed through the Senate and is now heading to the House, to establish that regulatory framework for stablecoins. But according to the Wall Street Journal, Expedia Group and other large companies such as airlines are also discussing issuing their own stablecoins. And apparently the DTCC is. I'm thinking about the Oprah meme, you get a stablecoin, you get a stablecoin. But Chris, I've always wondered, is there only so much fun you can have with your own stablecoin, or can you see a use case here for these giant merchants? Is this just, this is the hot thing, we better go investigate it? Or is there a real tangible bit of value here?
I mean, I think I'm in the camp of, maybe this is the hot thing and everyone needs a stablecoin strategy and they're not quite sure what to do. But I mean, these sorts of branded stablecoins, I think have worked really well in terms of, think of them akin to some sort of reward token or loyalty points or that sort of thing. But I think forcing a user to adopt a branded stablecoin and then use your stablecoin at the checkout on your shop probably creates a lot more friction for the end user. It might be better for the merchant, like an Amazon or Walmart with lower fees, but I think it creates more friction for the actual end consumer to go now and be forced to acquire or somehow get access to the stablecoin that's linked to a branded entity and then go pay with that stablecoin on platform. So and I also kind of think money tends to have network effects, as we've seen, and that extends to stablecoins. So you see things like USDT and USDC have strong networks, and those networks are growing, and you've got this long tail of 200 plus stablecoins struggling to get to scale. So does adding Walmart's branding change the direction of that kind of network effect or that momentum? I'm not so sure, but I'd love to get John's take on it.
Yeah, I think when you look at an announcement like this, I mean, it does remind me that I'm getting old, number one, because I feel like I've seen so many of these over the last 15, 20 years where, particularly in the US, and these two brands in particular, at various different points have focused on building their own wallet or looking at various other different technologies to apply significant pressure onto what's a huge cost base for them on their interchange, and it gives them very strong arguments there with, the car brands and the current cases that are ongoing in the US and the DOJ investigation to perhaps give some further credence to negotiation positions there. I'd agree with Chris's view on that. think the Pareto principle would apply in these cases, right? Like, I mean, everyone's going to try and have one. In the end, it's a handful that actually will get any sort of scale and be successful. I think the Genius Act will have will be a force multiplier effect, I would say, for Circle, for sure. Maybe it's be a bit more challenging for Tether with their regulatory position in the US, but they're winning by quite a long margin in emerging markets from what we see today. But a lot of this in particular, Simon, from my perspective, and it has a bit more substance. I think when Expedia accepted Bitcoin like 11 or 12 years ago, and I'm not sold completely on the case of everyone having their own stablecoin and it being completely interoperable. I think maybe there's something related to the rewards that Chris mentioned, but I think a lot of this is just to put pressure on what are significant cost lines two very margin sensitive businesses have within their core retailing operation too, and they've both been very vocal about those positions. I think Amazon remove Visa, or was it MasterCard in Canada last year at some point? I can't quite remember which one. So they're used to kind of making these kind of pushes as well. I do think all these companies are exploring the technology. It may be on the collection side. I think it's particularly interesting for them on the expatriation side too, for either retained earnings or payouts for sellers or things like that in markets where it's particularly difficult. Like if you think about, Simon, just say someone who's in Pakistan today who may have an AWS bill in Dublin, right? And the AWS bill is going to be critical for that guy to pay. It's going to be extremely difficult for that person to get dollars today, extremely difficult. So is there use cases there? I think there is. They have high degree of utility for that kind of business, where I think someone much smarter than me had referenced that's first line debt for most companies, right? That their cloud bills. So I think there's real practical utility to some of those cases that probably lie a little bit beneath the headlines for those companies there. But I would view it also as positive PR in this case, right? I mean, if even getting those companies to kind of look at stable coins and consider it, like, it wasn't really a realistic goal, even I'd say a year, 18 months ago, so I think I would track it as some sort of progress from that perspective, and certainly triggered by the Genius Act as well, and all the noise that's been.
Two things can be true. It can be a brand you've heard of plus stablecoin equals headline in the middle of stablecoin summer. But also there's genuine on-chain data now from Artemis and others to show that the volumes are not only there and real, but they're exploding. And the real world adoption in the global south is there. The question is, does the Genius Act become a tipping point, and where does it? The corporate treasury use case is one I hear coming up quite a lot, Chris, because we saw, I think a couple of weeks ago, we covered Sony are looking at issuing their own stablecoin, but they have their own bank in many markets, and they use that bank to move dollars and other currencies kind of around the world. And their rationale was, well, if we can collect the treasury yield and we can move those treasuries around as simple as we can send an email like you can with stablecoins, perhaps that becomes a path for them to be collecting yield on daily payment operations that's instant and 24/7. That was like quite a thoughtful approach that I hadn't heard articulated before. But I wonder about the corporate treasury use case for these guys, perhaps more so than the collections use case, or just purely the narrative wars for kind of what's happening in various lawsuits and whatever else. Do you see the corporate treasury use case there, Chris?
Yeah, look, I think 50% of our TPV is B2B payments. And you could argue in some way, shape or form, that's some sort of corporate treasury use case. But yeah, lying underneath the hood, it definitely is global businesses that have cash around the world that are parked in multiple different bank accounts and need to move, have big cash pooling requirements and that sort of thing. You get a lot of idle cash stuck in the kind of system. And I definitely think that, maybe the corporate treasury use case is probably a better place to start than issuing your own stablecoin if you're someone like an Amazon or a Walmart, that's for sure.
I know Mercado Libre has its own stablecoin, and they use that primarily for the rewards use case. John, I don't know if you're familiar with the Mercado Libre token, if you can speak to that for a moment.
Yeah, I mean, I can probably speak more to the use cases Chris was referencing. I mean, it's, I think we'll probably get to this at the end. That's a lot of the work that we've been doing with Chris over the last 3 or 4 years too, right? Like practical real world use cases of making sure that you're not building up stock in an emerging market, right? In a currency that's a liquid there. I think the other use cases around rewards for sure are interesting. You know, I am a bit more with Chris in terms of, I think the corporate treasury adoption of this, particularly in these markets, is extremely beneficial, you know, to treasurers and heads of finance, etc., and CFOs, because it's a thing I imagine most of them would stay up at night on. And in the cases I mentioned, Simon, for, let's say, like Meta and ads, or, you know, Google Cloud or AWS, like that's a real business case on the revenue side where you can't get paid, right? And someone's going to create a bad debt with you. Maybe you're going to churn a customer. Maybe they'll buy a slightly inferior, maybe they might buy from a provider who actually can offer to pay in Tether or USDC or another stable coin, you know. So I think the use cases are there. And I think those ones in particularly on the treasury side, currently as things stand, I think have the most utility to really drive benefit for businesses, which are more like an infrastructure play rather than being super visible out to the rest of the world.
Chris, is there anything else from a global supply chain standpoint or merchant use case that you're seeing as you speak to your clients and prospects? What are you seeing and hearing?
Yeah, I think we're seeing more and more merchant demand forcing PSPs to really articulate their stablecoin strategy well. And, you know, I mentioned before that we started to see, you know, the way they've approached it's almost like 3 steps. They come to you and they go like, how do I look at this? And they start with some sort of treasury use case that they can control the risk. You know, maybe that's a B2B stablecoin settlement, or it's some sort of corporate treasury movement. Then they see the benefit of it. And then they're like, how do I do actually B2B2C payouts actually for allowing my merchants to pay out into the global south if you're an e-com platform or a marketplace. And then I see some early adoption and some early conversations I've been having where those payouts are now landing in wallets of users in the global south. And they're going, how I actually now want to pay, which merchants accept stablecoins. Yep. So you're going like B2B treasuries, feeding payouts, it's kind of feeding merchant acceptance. And that's why I think this, you know, even though the Shopify announcement just kind of rubber stamps that it's go time for the merchant acceptance use case as well. And I think you're getting this nice flywheel between the different use cases, and we're definitely seeing those kind of interact quite nicely, and I'm quite excited about what the next 6 months look like as some of those get to scale.
John, does that resonate for you?
For us, yeah. I mean, the ones we see, I think, are very similar to probably what other guests would have shared as well, Simon, or discussed with you before. Like, we've had remittance companies funding us in, you know, USDC, USDT this year, which, you know, people were not super interested in doing it 18 months ago. I think payroll companies as well looking to that with us. We're also having cases for, we'll say, employer of record models where they're hiring IT staff where they want to be paid in Tether or paid in USDC directly as well, you know. So you are seeing those use cases across the board. So even for us, like it was when we started, more just a function of, okay, we have a particular challenge in this market where we've got a choice of either building up some stock and taking some time, or we use stablecoins to take the money out, to now where it's much more a fundamental part of the offering for us, driven by our dialogue with customers, where they had a desire to fund us in stables as well. So we participate in the CPN network, and we're kind of launching some stuff there this week with those guys. But overall for us, it was more kind of out of necessity, Simon, rather than us saying, okay, we need to have a super defined stablecoin strategy. On our end, it's just about being super close to our customers, having a broader dialogue as possible. And from those dialogues, it's become very apparent what the opportunity was there. And as I said, we've also seen those cases even amongst our own employees asking for things, right, in terms of paying them in stable coins, etc. as well. So I think those cases that Chris had mentioned are probably not talked about enough, really, and I think represent a really big opportunity for folks in the global set.
Yeah, the growth is ahead of those use cases without question.
Yeah.
I think that point about like following the customer demand is one that's often confused when there are big headlines like Amazon and Walmart maybe doing something, which is, yes, okay, that may be headline grabbing, but the real volume and the real data is actually here, and that makes it very different. To your point earlier on the Expedia adding Bitcoin in 2014, this is worlds apart from what.
Yeah, it's completely agree. The other one I think Chris and I discussed before was around, I guess depends on how you define these B2B use cases, but I would think about, we'll say like a Unilever or other businesses who have, stock built up in a certain country who would look to liquidate it, and say like a Nigeria or Mexico or other markets. We found that, since the Stripe acquisition, really, and the Genius Act and everything else, that's really sped up the dialogue and almost converted the pipeline, I'd say, that we did have of those B2B use cases into stablecoin use cases, because they've accelerated the dialogue with the customers where they're saying, okay, would you be able to take it out? Off ramp to us, could we give you stables for that? And cases the other way as well. So I think you will see more of those use cases move to stablecoins as well, because it's kind of acted as I would say almost a marketing incentive to CFOs and treasurers and other folks to say like, okay, maybe there's a real world utility here where we don't have to have that problem, where we can liquidate that position, and it's actually going to be much more cost effective, which, as Chris or I know from emerging markets, in some cases 3 or 4 years ago, it wasn't that cost effective, and it was quite expensive to off ramp it, and it was difficult to get people to buy into those cases too. But we've seen that, I think, is probably a more substantive change, Simon, over the course of the last 6 to 9 months.
I want to come back to the economics of that. But first, before I come into those economics in the next story, I've just got to stop here and thank our sponsors. So we'll be back while we hear from the folks who make Tokenized possible.
This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. Tokenized is also brought to you by Avalanche. Major banks, fintech challengers, and industry leaders are using Avalanche to create new business models on a fully customizable blockchain infrastructure. Think of it as more than a blockchain. Think of it as an entire network built for financial institutions to innovate. With purpose-built layer ones, institutions can tailor digital asset strategies to their exact needs while still tapping into the power of a public blockchain, innovation, developer communities, and seamless interoperability. Join the institutions shaping the future of finance on Avalanche, and you can learn more at avax.network.
All right. Thank you very much to our sponsors. The next story, I think we're going to cover the economics in, but I want to contextualize this giant story before we do, which is JP Morgan has announced the pilot of their US dollar deposit token on Coinbase's Base blockchain. So JPMD is backed by deposits, not treasuries, and is positioned as an alternative to stablecoins, so being a deposit token. It's designed to offer many of the benefits of having cash on a public chain, but it's linked to commercial bank money, which offers FDIC protection and potentially for large corporate treasurers access to JP Morgan's additional suite of capabilities, which large companies will definitely care about, such as JP Morgan Connexus. And before I get into the economics, actually, John, I want your thoughts on this. Why do you think such a global bank is doing the deposit token versus a stablecoin?
Yeah, it's interesting, right? Because I think if you listen to any of the comments from Jamie Dimon over the last few years, I don't think many people would have suggested that you'd be sitting here in June 2025 and you'd be talking about deposit-backed token from JPM. So I know from talking to some banks, and even the event I mentioned we attended, Simon, for Circle, like I was even myself surprised with the level of bank interest and participation. So I think in many parts of the larger financial institutions, and certainly if you talk to executives who run these banks, like this is something they've been thinking about for some time. Whether or not they've been able to, verbalize that and vocalize their opinions, if they're U.S. executives, etc., it's been more tricky. But I think you'd be surprised at the amount of people in these organizations who are working pretty diligently on these kind of activities. And I don't want to ruin the surprise for you, but I think if you look at kind of the kind of people these folks have been hiring over the course of the last few years too, it wouldn't be a major surprise. They've been looking at these things. It is a unique spin on it, and I think it's an advantage that's unique to JPM given their size. In the US, JPM, as you know, has performed quite well in entering the UK market too. As you know, in what we do for a living, it's a lot of trust and reputation. So if you're bringing trust and reputation to moving money around, I certainly think all of those things help on the adoption side. Of course, like every technology in the B2B space, it's entirely down to execution as well, right? And how that will be used. So it'll be certainly really interesting to track. I think kind of obvious in terms of why they are doing it. It's I think good and smart defensive protective move longer term, and to be quite frank about it, a quite innovative approach as well that they've taken here. So it'll be interesting to see how it plays out. Conversely, on the flip side of that, have many people who would say, we've been running our crypto company, Chris and others, and they've not been able to get banked by JP Morgan in the past few years as well. So it'd be interesting to see how the broader community kind of receives news like this. It's an endorsement, of course, for sure. But these organizations have large tentacles. They're many faceted and many sides, and sometimes one part of the organization is not necessarily in sync with the other. But yeah, I was quite surprised with Simon. I thought really, really interesting, and we'll be keeping a close eye on it for sure.
Well, speaking of that listening to customers thing, I immediately thought how many JP Morgan customers are asking what their stablecoin strategy is, and they needed to have something to point at. And of course, JP Morgan has JP Morgan Connexus. We had Nikhil Sharma, who's the exec director of their digital assets business, on the show last episode. It was with the AVAX Summit. And he said something that blew my mind, which is I think Connexus has cleared something about $2.5 trillion of volume so far. This is their real-time 24/7 settlement network, but it's only inside the walled garden of JP Morgan, which happens to be massive and really, really large. And on that basis, I actually ended up in a bit of a back and forth with the CEO of Airwallex, Jack Zhang, on Twitter or X about a week or so ago. And what he was saying is like, I don't see this pre-funding going away. I don't see this economics use case. I have JP Morgan Connexus. I have really strong economics. But Chris, I know you've been talking about this sort of the draining pre-funding accounts for a very long time. What are the corridors specifically that you see the opportunity in for corporate treasurers, for others to have the economics? And do you think something like a JPMD or something else could deliver against that? But first on the economics, the benefit for certain corridors.
I mean, as we've discussed previously, the look and feel of instant payments that we have today is not really instant. It's a bunch of pre-funded accounts, as we know, held around the world. And I really truly believe that if enough FX moves on chain, so you've got other fiat currencies that move on chain as well, you're able to move from a system that works today from like a liquidity pool settlement system, which is pre-funded in all these accounts, to a single threaded payment system using stablecoins and RTP rails. And that's where you can get this draining of pre-funded accounts. Yeah, I mean, to your point, so I do think, there's corridors in Africa, LATAM, Southeast Asia, where, they're notoriously, pre-funded markets. Think markets like Philippines, you've got to send SWIFTs a couple of days ahead of time so that you can make sure you have enough liquidity in Philippines to do your PHP payouts if you're a remittance app. So I do think there's tangible benefits and economic benefits of, draining some of these pre-funded accounts, putting 4 or 5 days of capital to work elsewhere in your business. I think treasurers are starting to, get wind of this. How that kind of relates to, kind of JP Morgan and JP Morgan deposit token, I think, to John's point, the scale of JP Morgan makes this very interesting. Many people have been talking about deposit tokens for quite some time. I mean, there's pros and cons to deposit tokens, I would say. I mean, you can definitely see the pro for JP Morgan's business in terms of using that as a settlement currency for JP Morgan's securities business. The fact that it's FDIC insured is great, but I don't think that's a USP, because the reason it needs to be insured is because banks go bust and those deposits go away, and therefore someone has to insure those deposits. And if you, I think, direct one-to-one treasury-backed non-fractional reserve tokens like a Tether or a so-called, are probably still a better instrument. But yeah, and then I guess on the cons side of that is, there's really the permissioned nature of all of these bank grade stablecoins and stablecoin projects is still something that I think is is probably a hindrance to adoption. Even though JP Morgan's at scale with all of their millions of customers around the world and their large payment flows, it's great that they've moved and now issued it out of this closed garden and put it on a public blockchain being Base, but it's still only permissioned to JP Morgan customers. So I think getting that balance right of like, what does one of these deposit tokens look like out in the wild, so to speak, for everyone to use on a permissionless blockchain? I think that's still the question that I have to see where these things kind of get to.
Yeah, on your, I didn't read your back and forth, Simon, with Jack fully. I read what he posted. What I took primarily from it, and I would have some concurrence with Jack's comments around the regulatory arbitrage side, working in emerging markets day to day. If you think about today, if we have to send money to, for a remittance company in Nigeria, I have to have my IMTO license as the local in Nigeria with the CBN. I also have to have my EMI in the UK with the FCA, and all those things I think are well intentioned. Where you have any kind of arbitrage around that, I think was one of the things that Jack was trying to highlight too, right? That like compliance is obviously going to be really important. Of course, you would argue with the technology, it being on chain, these things should be far easier to do, right? Using that sort of technology. I think a general point he was making on the speed side, I'd say for sure in some countries it's a relevant point, right? I think it's your argument is much more substantive, Simon, on what could you be doing if you're not pre-funding. You also have to remember that businesses like Airwall accept flow on both sides. So often Jack is using his own liquidity, paying out quicker too. So you may not also be experiencing all of those pains there. But I do think there is real substance to the regulatory side of things. I think, not because he's on the call with us, but I think, Chris getting regulated in the UK to send money there, and, other businesses like AAA doing it in Singapore. And if people are taking those approaches, it adds a lot more credibility, I think, longer term to how you move those things. It's also hard for me to imagine a world longer term, Simon. So it's never happened in human history, right? Where everything we all do is completely interoperable, and that we're all going to be the exact same. And, the Nigerian government and the Argentinian government are going to be in symbiosis and happy to just trade money freely amongst each other. So I think the technology has the opportunity to improve those relations and maybe take out some of the mistrust you have, but when those kind of things happen, because obviously the ledger is immutable and people can check the information ourselves. But I did think there was considerable merit, at least in the regulatory arbitrage commentary that he made as well. And, from knowing Jack's business very well, I can understand from his perspective why he's not seeing it there, but we see it the opposite in ours, and in running a business in emerging markets, and see demand on both sides, from people funding you in stablecoins to also the receipt of them as well. So I think, I don't think he's going to be on a complete island on his own there, but I'd say at some point his customers also will be pushing him a bit more on that, knowing some of the folks that do business with him today.
Yeah, indeed. And I should say, I don't wish to throw the guy under the bus. We had a phenomenal conversation, and his point is all extremely well made. And especially with regards to compliance. But Chris, it might be worth sort of giving people an update on your compliance position as well as other people's compliance positions, because I imagine you get that question a lot about, like, what about compliance? So how do you answer that?
Yeah, so we've taken an approach, having built in the space for 5 years now, that we needed to be heavily regulated on both the bank side and the blockchain side. So we went out and got EMI licenses. So in the EU, the UK, we're about to get a Singapore MPI license. We've almost got full coverage in the US, on the MTL side, and we have similar crypto asset licenses in those markets. And the licensing gives you the framework to operate. And then you've obviously got all the nifty tools you need to use to do things like KYC, KYB, and then more specifically, what differs between the fiat world, as you'd know, and the blockchain world is on-chain and blockchain analytics tools that allow you, like Chainalysis, to do transaction monitoring, screening, blocking incoming payments from nefarious wallets, risk rating payments. So I think you definitely have to build with with a compliance first nature and intention. In early doors, I think that's changed a little bit now because the regs have caught up. Early days there were no regs, so you had to kind of build, and we used fiat payments regs to kind of architect our business and our compliance program so that we were operating as if we had a license, even though there were no crypto licenses back then. Now those frameworks are becoming a lot clearer. Mika, we know that Genius just got past the Senate, 2 days ago. So I think the frameworks are there. They're quite pragmatic. They're not too different on how we do fiat payments today. And I think you just have better tools in the blockchain to actually manage risk.
I think you do. I think there's a new type of risk that emerges, which is the arbitrage between the two. It's something that, Soups, the founder of Sardine, he was at Coinbase in 2014. When you're head of data and head of fraud in an emerging area like that, you very quickly get used to people trying to arbitrage the two systems against each other, and you need to build like a pretty robust compliance house to manage both of those sets of risks, not just your fiat risk, but your crypto risk, and kind of build the connective tissue between those as a regulated entity and anybody who frankly is responsible in this space. Well, listen, that concludes this episode. I will be talking to you guys in the not too distant future on an episode that's about to drop. But I do want to just thank you guys so much for your input on today's show. And Chris, remind everybody where people can find you at BVNK.
Great. You can find me at bvnk.com and also on LinkedIn.
What about yourself, John?
I'm not super used to leaving my social media on there, Simon. I like when people can't find me generally, which is probably a bad thing to say for a chief revenue officer. But just at thelocal.com, you can find us there and contact us directly. And always happy to have people reach out direct and have a conversation.
And you can find me at SY Taylor on all of the things. You can find Sardine at sardine.ai. You can find FinTech Brain Food at fintechbrainfood.com, because I seem to take the opposite approach to doxing myself. But ladies and gentlemen, thank you so much for listening, watching, however you're consuming this. Please, if you haven't already, subscribe, like, share, do all of the things that help this show grow. We keep hearing feedback that you're starting to really enjoy the show. Please help it spread with a little podcast that could, and with your help, we'll go a long way. Thank you so much, and bye for now.